Next up, he already revealed it on the panel, Richard Flohr, that we know each other well. Richard, will I think touch upon some points we heard to some degree, but the big question we're getting a lot is, in the US they use leverage, debt on debt from our German investors. How does that work? And Richard will shine light on that by showing us how debt funds can create alpha, the use of leverage to enhance real estate returns. Richard, no more introduction needed.
Thank you, David. So I've learned a lot at the conference today. I've learned about the German political system. I've learned a lot about European markets. And I've also learned when David asks you to speak at a conference, don't go at the end because everyone else is going to talk about what you want to talk about, right? There's only so much you can say about real estate debt and keep it interesting. So the good news is it's a low bar and I hope to clear it. But a lot of what I'm going to talk about has been discussed. So I won't repeat it. But there are some differences that the US market has relative to some of the other markets we discussed. So what I'm going to do is try to work the clicker. There we go. So how do we work, right? The previous presenters, they were basically teaching you calculus, right? There was a couple of charts up there. I've been doing this for 30 years. I couldn't follow them. And I'm not saying they were bad slides. I'm just saying that they were going into detail. This is addition and subtraction. What is it that we do? How do we create alpha? Now, our debt fund is only senior debt. So we don't do mezzanine. So I'm going to stick to the senior debt. Now, that doesn't mean mezzanine's a bad idea. It just means that's not what we do. So what do? We make a loan. Oh, shit. We clearly don't do AV work. There we go. We make a loan. That's what's here, right? This is a theoretical loan. It's a 75% loan to value. We've got 25% downside protection in the borrower equity. How is it that we make money? What do we do for our investors? Well, we do something pretty simple. We basically either sell or finance this piece of the capital stack. It's 0 to 50, right? It's not 0 to 50 on every deal. Some deals are a little more, some deals are a little less. Why do we do that? Earlier today, Jeff Fastoff talked about we're a private debt vehicle. You don't want us holding this risk. This is AAA risk. Now, it doesn't mean every loan we do is AAA. That's not what I'm saying. I'm saying that if you think of where the rating agencies apply subordination levels, it's sort of the 0 to 50% loan to value. You don't want us holding that. If you want that kind of paper, buy it in the public markets. You get the same return and you get liquidity. So just by doing that, we basically isolate this piece of the capital stack, 50 to 75%, and that's what we hold. Right? That's all that we do. I'd love to tell you that this was a complicated business, but I know it's not. You know how I know? Because I can do it. So that's all we're doing, and by doing that, we're creating alpha. Now, alpha is one of those words, right? You know it when you see it, but you can't do this by yourself. That's what you're getting when you invest in it.